Good morning, everyone. Welcome to this live intraday strategy webinar on SB Trade Desk. Today is Thursday, October 15th. Good morning to everyone here in the room. I see some messages. Happy CPI Thursday to you as well, Eileen. So we're about 30 seconds out, guys. We are expecting consumer price index a weaker print this month. So for September, we're looking for a contraction of 0.2% on the month-on-month. Headline read is expected to hold at 1.8%, which is going to be the core year on year. This is stripping out prices of food and energy. So 1.8% really sticky in the core inflation. Month on month and year on year, we are expecting some weakness. So the risk here is that it's baked in already, or if we get a stronger print. Dollar trading more or less near support, about 5 seconds out. And survey says CPI for the month of September comes in at -11. Wow. That's a really bad print. Expect some serious volatility here. -11.36%. I'm sorry, that was Empire Manufacturing. -0.2, right at expectation. 1.9, an uptick in year on year. Interesting. All right. So it's actually a stronger print here, guys, on the core read. So 1.8%, that's going to be the major read that the Fed is looking at. We were expecting further weakness. We got pretty much at expectations for the month-on-month, year-on-year, stronger than expected. Core uptick is going to be very strong ammunition for the Fed. So you should see some dollar recovery here. Here's the dollar index coming off the lows. This is essentially just the simple low that we made back here in September, 11,865. Near-term resistance, look for the initial median line that we've been working with, but beyond that, you'd look back up into the swing lows for the weekly opening range, and that was going to be 11,913. So some interesting moves here on the back of a surprisingly stronger print. You know that 1.8%, guys, just to give you some relative reference here. If we go back and look at historical prices, 1.8%, we've been stuck in this 1.8, 1.7% since the start of the year. Here's January. The first year was 1.6. We climbed into 1.8, fell back to 1.7. This is the strongest read we've seen on inflation since July of last year. And certainly we've continued to talk about this in the room, guys, how the dual mandate for the Fed, maximum employment and price stability, which is inflation, of the two, inflation seems to be the one that's been the laggard over the last, throughout the recovery, essentially. And here we see inflation starting to uptick. So definitely we'll start to bring to light some of those calls for a possible interest rate hike this year. Testing median line resistance now. This puts the downside, or it flips the bias, rather, on the Aussie trade that we've been looking at. We took some Aussie shorts last night on a scalp basis. We'll take a look at that. Kiwi was highlighted in today's scalp report. And then we'll take a look at some of the radar charts. Aussie Kiwi in a very interesting area. Dollar yen also at support. Let me take a quick look at what dollar yen's doing. So you can see dollar yen also coming off that support confluence we noted on the radar charts yesterday. Look for some upside there. All right, so we're going to jump through these setups from last night rather quickly. I do want to leave as much time as I can for your questions and trade setups, so do feel free to throw those on the message board as we go through the setups. But again, for those of you who just joined in, I saw a couple of guys just pop in. Here's what the CPI print looked like. The -11%, which I popped out at me first, I apologize about that, was for Empire Manufacturing. So manufacturing seeing a huge drop off after a larger decline of 14.67 the previous month, coming in at -11.36. The CPI figures, broadly speaking, you'd say this is a positive print. Hey, Dale, great to see you in the room, man. All right, so relative performance on the greenback. Before we jump into these, you can see that as a split decision. The dollar was pretty much trading at support right ahead of this release. You can see biggest gainer on the day, Kiwi dollar up 0.85%. That's at resistance, and that was the highlighted scalp from last night. Here's what we look like heading into last night's trade session. So the start of Asia looked like this thing was just holding the upper median line parallel. This is a sliding parallel for the operative formation that we've been in off the lows from last month. So we've been in this for multiple weeks at this point. Constructive above 68.11 was the objective. Topside break looking for 68.81, which is a nice confluence region. Former swing highs, not really a major key level on the horizontal basis, but certainly the upper median line parallel was right there. It's exactly where we capped out this advance. Okay, here's what Kiwi looks like now. So we came right into that level of resistance. It's now holding. You're seeing some dollar strength slam this lower. I'd be looking for support, same as last night, no change. Near-term objective for the immediate bias remains constructive above 68.11, and that's really what we'd need to get below to open up a target down at the lower median line parallel. But I really wouldn't get too aggressive on the shorts until we break below this. The trade that was sort of jumping out at me last night, guys, was actually a short Aussie. It wasn't a short Kiwi because Kiwi, the upslope and the dominant topside trade still remains in play. Aussie had a much more attractive short exposure on the back of the employment figures that we got last night. Here's what those look like. So employment, we were expecting to see a gain of 9.6 thousand. We got a contraction of 5.1 thousand. Okay, unemployment rate did hold at 62%, but stop traffic 64.9 on the participation rate. That's a drop from the expected hold at 65%. What does that mean? It's very obvious, not a very bright picture on the employment picture, but price action spiked right on the back of the release. And that was a gift, again, for a fade move to the downside. So we'll go over that setup in a moment. But before we do, for New Zealand, this is pretty much the initial event risk for the day. Heading into this afternoon, this evening here in the United States, in New York specifically, you're going to get those New Zealand CPI inflation numbers as well. It's going to be the final piece of data we'll get this week on this pair. So near term, immediately looking lower back into this median line parallel confluence with the 38.2. And that's going to be the near-term support structure we're looking for. Downside break below that, we'll look to sell rallies targeting 67.70, 67.35 into this region, into the U.S. Open. Look for some possible long triggers here. The momentum signature has been pretty tired in that we have been able to push any higher in momentum, although prices continue to press new highs here. So we'll be looking to see how deep that pullback gets. Remember, on the daily charts, again, on the back of the 8 or 9 day stretch that we saw here to the open up of the month, the last time we saw that, we saw a quick correction, and we noted this a couple of days ago before the continuation. We got a 1 day pullback and then a nice reversal candle to the upside. So one thing I just wanted to point out is the targeted levels that we have on the levels right here, on the scalp targets rather, excuse me. A little tongue twisted as usual these mornings. So the first level, 68.81 that we just hit, was just a very clear pivot in price. You're talking about the lows from June 17th, 18th, instant highs and resistance as we broke below on the 29th of June. And here we are surging right into it. Next soft target, 69.28, another very nice pivot, that swing high from the 25th. But really, there's nothing major until just shy of 70. 69.89 is going to be a 50% of the drop from the highs we made in, what is that, March? Or April, rather. So expecting some kickback here in the Kiwi. Again, I've been playing it, well, the risk trade, as it were, through the Aussie, but look for near-term support here at 68.12, 68.11. Here's what Kiwi looks like on the 5-minute. And obviously on the back of that print that we just got, there was actually a beautiful trigger that just gave out, not only in momentum, but also in price. So there's a price break right there. More importantly, lower high, lower high, lower high, higher high, higher high, some strong divergence into that move. Interestingly enough, and more importantly, as far as the target's concerned at 68.11 on this downside swing, look where the Tokyo lows come in, just below that. So 68.11 target on this would sort of be the right move to look for a support on Kiwi. Remember, the broader trade near term still remains constructive while within this. So if you're scalping the short side, half leverage, third leverage, and be really nimble on the targets. Questions on Kiwi before we move on? All right, and we'll be watching those New Zealand figures later tonight. A quick preview on that. Here's what the market expectations are. For consumer prices, we're expecting a slighter, weaker print on the quarter-on-quarter, 0.4 drop to 0.2%. More importantly, the year-on-year number, which is the headline print, is expected to hold at 0.3%. We already got the upward revision to 0.4 for last month. So it would be a little bit of a softer print for the year-on-year. And again, 1745 here in New York tonight. All right, 68.11. I'll mark that right here. Okay, next on tap from last night's piece was the euro dollar. This was a piece I put out on Daily FX as well. You know, really interesting levels at this point. We're looking for a rally to sell is sort of the theme of the euro dollar play. If you guys have been here for a while, you know that euro has really been out of focus for us for a couple of weeks now. We had this chop fest here, which lasted a good 2-3 weeks of major consolidation above some major critical technical factors. You're looking at the 200-day moving average, the 100-day moving average. The monthly open came in at 111.75. We tested that 3 days in a row. And we just sat below that for so long. Here's the break we made last week. Wasn't really validated until this candle right here, which finally broke objectively the monthly opening range. And this is where the monthly opening ranges and the weekly opening ranges, guys, come into real benefit for us. Again, not a trigger to jump into a trade, but certainly justification for the broader bias. And the break that we made here, albeit that on the 8th we tried and failed at the monthly opening range high, which was 113.17. This was the first day that we actually closed above it. So on the 9th, shifted the focus to the upside. This week, yesterday's breakout shifted the weekly opening range higher. Key resistance, 115.12. What's 115.12? Very easy, is the reversal day close after the high day that we made in August. And it coincided beautifully with a basic median line parallel off the highs. We failed just ahead of that, guys. The high for the night came in at 114.94, so less than 20 pips away. Here's what the scalp looks like on the euro. So the idea of looking for a high to sell was the right play. We didn't quite stretch into 115. Momentum was a beautiful trigger on the downside. We've been watching this trigger since last night. Finally gave out earlier in European trade with a failure to hold above that 114.65, 114.74 region. Opened up declines into initial targets at 114.43, and here we are checking target 2 at 113.94. So at this point, similar to what we're looking at with the Kiwi, okay, immediate bias remains weighted to the downside for a little bit of recovery here in the dollar, but really wouldn't be looking to play aggressively past 113.40. This is going to be the weekly opening range low. Depending on where we are in time, you'd essentially be looking for a rebound off of that lower median line parallel, or actually, excuse me, yeah, the lower median line parallel. Okay, the October opening range high, 113.17, is right there. So from a technical standpoint, real clean symmetry. Opening range for the month, break, tested as support, confluence with the lower median line parallel, and then off to new highs possibly. One other thing we'll note, we'll want to see what today's close looks like. So we've already cleared the previous day's highs. If we close below, or if we push below yesterday's low, it'd be a pretty significant outside day reversal at the highs. And certainly if we break below and close below yesterday's low, it would be a nice reversal momentum at 60. That would be indication or suggest that the topside momentum is really waning and that you haven't gotten validation for a broader turn yet. Remember, I really can't stress this enough on the euro, guys, the weekly chart. So we'll be looking for a dollar index, by the way, 11,916, what we talked about at the head of the webinar. It's your next topside objective. But it's important to keep in note, I put this on yesterday's piece on Daily FX, the weekly chart for the euro, and why this region is so critical on this week's close. You have the 52-week moving average, comes in at 114, right on the mark. You have 114.35, which is 100 off the high. Also the swing highs on a close basis that we made earlier this year. And you have this consolidation feature. Let me extend that trend line. Oops, wrong direction. Okay, so if we're not able to close the week above it, it's going to count as yet another failed attempt. You had 2 already this year on a weekly basis that failed miserably on every attempt for a topside break of this formation. Also, if you watch the accompanying video, guys, momentum, if we do break 50 to the upside, would be the first topside break above 50 we've seen this year. The first topside break from oversold conditions since way back here, 2010. Okay, and that was obviously the charge that led right into the into the 2011 highs. So real critical. Watch this week's close. I'd be very interested to see if we do close above it. There's really nothing on tap until 118, guys. Believe it or not, from a longer term prospect. Again, these are weekly charts. You'd be looking for a longer duration rally towards that 118 handle. Near term, here's what it looks like on the 30-minute. All right, so look for the weekly lows, 113.42, 113.17 is the former opening range high. And again, if we'll be looking for long triggers as we get into this region here, right above the upper median or the lower median line parallel. That is Euro. The abomination is abominating at the moment, says Gary. I assume you're talking about dollar yen. The abomination finally made a move yesterday. For those of you who are new to the room, we call this the abomination just as a joke. It's been a trade that has caused me a lot of grief earlier in my career, but certainly when the setup is there, the setup is there. Look, you don't want to be attacking the short side. We talked about this in the radar charts yesterday. So, by the way, before we move on, Gary, any other questions here on the Euro before we move on? So those are both nights scalp update on the intraday. Finished Kiwi, finished Euro. Let's jump into this trade for Gary real quick. So here's what dollar yen looks like, or here's what it looked like last night. So we halted and saw a quick rebound right off the monthly opening range low that was made on the second day of trade this month. That was right around 118.70, and that's exactly where yesterday grounded. So we saw a little bit of a rebound into the open of Asia Pac. That failed miserably, and the key support region that we were looking for, 118.39, did inevitably get triggered. From here, I'm expecting some real wicked price action, Gary. Okay. Don't forget, on this pair, there's been so much pent-up interest in it as it continued to consolidate for over a month. This is over a month and a half. It's the 24th of August. The low day close for that August spillover, specifically that we made on the 24th, and just a basic sliding parallel here. So if we take the operative trendline support off the lows that we made in 2012, tagged again in 2014, mirror that just to the swing lows that we made in late 2014, you can see really nice. Catching that confluence low with the 1618 on that spill on the 24th, and here we are again checking it as support. Note also, right around that 118.38 area, the swing lows and the March concerted low, and then the pivot break we made in February. So a nice area of support, could get some upside. As far as the scalp targets, Gary, I don't have any, to be quite frank with you, on dollar yen. The only thing that we were looking for was that support at 118.23. We got it. From here, you probably get some upside. I really haven't been interested in trading this just as a disclaimer, guys, from the fact that the quarter of the daily ATR has now contracted to just 20 pips. Really tight for me. I mean, typically 25, 30 pips is sort of my sweet spot. But a 20 pip quarterly ATR, that's as tight as it gets. So Gary, look for some upside. I'd be looking for some resistance at this point. Up near 119. let's do this. I'll just take a quick measured run of just the spill off that high that we made last week. Sorry guys, a little lag in the computer here today. Come on. Yeah, 119.30 is sort of what I'd be looking at for near-term resistance on dollar yen at this point. Like I said, there's likely to be a lot of whipsaw here. Okay, so as the ATR starts to expand, so will our interest in the pair start to come. But at this point, the only thing I wanted to highlight last night was that key support. We've now made a tag of it. There's good US data. Use this rally. From a scalping standpoint, not really interested in playing the long side. More so, I'd like that rally to get me in a nice short position that I can sort of take this swing back to the downside. Gary, does that make sense? Now, just as a quick background information, there was some commentary that came out of Fed officials and overnight with, I think it was Brainer coming out and saying, look, we're clearly failing the inflation target. And it's very interesting that he says this right before CPI comes out stronger than expected. All of this, guys, all of this information comes on the back of a weaker than expected employment picture. So it's interesting because for the last 6 months, employment has been stellar, right? 200,000 plus on every single month. But the inflation's been the laggard. Now that they're starting to get concerned about inflation, here's NFPs this month coming out super weaker than expected. And inflation starting to pick up. Long story short, still becomes a very difficult task to try to charge the Fed with moving on interest rates this year. I just don't see it. So with that being said, I think interest rate expectations are finally starting to sort of wise up. If you look at bond markets pricing for futures of interest rates, they are starting to price a March hike. So certainly all those interest rate expectations that were set for, obviously October's out of the window here, but December are starting to get kicked out even more so. So just keep that in mind as far as the dollar story is concerned. By the way, the next Fed interest rate decision is going to be on the 28th, so not next week, but the following week. And I think we'll get a much clearer picture at that point. All right. Any other questions on dollar yen? Gary, I hope that helps, man. He says it does. Many thanks! Exclamation point. Cheers, mate. You know what? I'm just happy it made a move, Gary. Honestly, we've been waiting for this consolidation for so long. I had a smile on my face to see the break. I didn't play it. Doesn't matter that I didn't get back into it. There's going to be plenty of opportunity to play it. It's just, this thing has been a snoozer. And with this break, opens up a lot of interesting opportunities in the yen crosses, i.e. Euro yen, Aussie yen. Sterling yen's a little bit of a hairy picture here because sterling's testing some major resistance. We'll go over that. Actually, let me jot that down. I expect to see a little bit more of a significant pullback in the pound, but sterling yen, a much wider ATR on the yen cross, one of the biggest, might be a good way to play this one, Gary. He says, me too, did some or made some dough on it last night, but I'm out for now. It's the best way to play it, Gary, and that's how to utilize this strategy best. We're not looking for the entire chunk. We're looking to be nimble in and out of the markets, and as long as our risk to reward, we're maintaining capital preservation as our primary focus. Gives us the flexibility to be able to play both sides of these moves. All right, so that was dollar yen from last night. Again, no scalp setup per se, but certainly a nice start to a final break here of consolidation. We've been waiting for the resolution of this for weeks and weeks and weeks. And let me just clean up these targets as well for you. Again, just a quick reminder, anyone in the room, if you need to take a quick snapshot of any of the charts that you see presented on any of our webinars here on SB, feel free to click that camera button in the top right-hand corner so you can reference these charts at your leisure. All right, next on tap is Aussie Kiwi. Please tell me someone saw this yesterday. Here's what Aussie Kiwi looks like on the daily. So this region at 109.35, 109.10, if you guys recall in September, we were all over this thing. The rejection of a break below, momentum failing at 40, a topside trigger break shifted our focus to the upside. We were loving the long scalps. When we broke back below the monthly open for September, it invalidated our long scalp. We've been neutral ever since. Started off the month highlighting that key support again. Then it got super messy. You broke below it, you closed above it, you closed below it, you closed above it. Again, bring it into a line chart to really give you a little bit clearer of a picture of where the closes have been. That's not what you want to see in a conviction break of support, especially a support that has been in play for 4 months straight. So we shied away from this. Not too surprising. Relative biases for the Aussie, for the Kiwi have been constructive. So obviously both players here appreciating over the course of the month. That'll tend to give the cross some back and forth action like we saw. But certainly this break here yesterday really opened up the, opened up the floodgates, as it were. Initial targets with a break below the monthly opening range was right here, 107.11, 107.23. Beautiful confluence region. 618 extension off the high, 50% retracement off the low. And obviously, I'm not going to really stress this, but we had the 200-day moving average, which snuck in just above that. This is a critical support. Absolutely paramount. If we close below this today, you're looking at 105.57 and the lower median line parallel as just initial targets. Why is this level so critical, aside from it being a simple fib confluence? Well, I'm sure you guys who have been here for a while are sick of seeing this, but I'm still going to show it again. Same slope off the 2014 January lows. Take a sliding parallel off of that same slope, has defined every pivot in price since. And here's that same slope again. Broke at a support, downside break, same slope. If we close below this today, keep looking lower. Keep looking lower. On a trade like this, not really looking to play back and forth price action. The play was either a rebound to the long side back into the upper median line, or excuse me, into the median line here, which it failed in overnight, or on a break to the downside, you just want to be selling rallies well below 107, period. End of conversation. This is the first 40 break we've seen in momentum since March, and really puts the focus back on the downside here for Aussie Key. Here's what it looks like on the intraday. I haven't actually updated it. Let's take a look what that looks like. Okay, so there's a closer median line structure in play just off the September highs. Actually, this is the late August highs and the September stretch high. That gives us a near-term target to the downside right around 106.15, lower median line parallel here heading into US Open, or into US Close rather, I should say. So keep that in view, right around 106.15. Just going to mark it here. Hey, what do you know? It's going to be the close low for that swing in May. Not bad. And then obviously the 618 retracement of the advance comes in at 105.57. Near-term bearish invalidation is going to be with the median line. So as long as we stay below that median line, even if we rally into it, I'd be looking to sell those rallies. Finally, a break in Aussie Key. Took a couple of weeks, but there it is. Hamid saying, what time frame is the best for scalping standpoint? And can you please illustrate in a chart how you scalp? Thanks. So we have the levels mapped out on the daily and the 30-minute. Obviously, guys, I don't expect you to be doing this on every single trade. That's what my job is. So you have the broader trend in focus. You know what your key levels are. You come into the near-term chart or the 30-minute to actually see the scalp targets. But when you're actually scalping, Hamid, when you're putting trade by trade, you want to jump into a 5-minute chart. If sometimes I'll jump into a 1-minute chart. It's very subjective. You know, I might be looking to play a rebound off this for the short. You might be looking to play the long off this support for the long. Doesn't matter. As long as we have a clear directional bias in view, and then we have our key levels that are mapped out on what we're looking to scalp between. The targets should typically be a quarter of what the daily ATR is. So if you're putting in 100 pips on a daily basis on euro dollar, for example, which is well more than 100 at this point, typically, on average, I'll look to play about 25 pips per scalp. If it's a 200 pip ATR and some of the sterling crosses well above, typically, on average, I'd be looking for about 50 pips per scalp. All right. Now, we're not rigid as far as having to book the entire trade at 50 pip profit, but we are rigid in having to take a 50 pip loss. So if the market goes against us, you're never going to risk more than a quarter of that daily ATR. As far as your profit's concerned, sure, when we hit the first ATR, I'll take something off, but I'll leave some on the table and try to see if we can get a stretch into the next target. So when we're looking to actually push the trade, you're looking for momentum triggers in the near-term chart. Just as you do in price, basic trendline support. You look for divergence. Here's some divergence on the Kiwi dollar trade early in European Open. Market making a higher high, higher high, higher high. The oscillator making a lower high, lower high, lower high. Divergence into a trigger break. Once this moves down, that's your trigger to get short. Stop against the highs. Looking for about 26 pips. All right, Hamid. As far as time frames, I'm usually looking at a 5 or a 1 minute even trigger to jump into the position. As far as when in the day, typically, personally, my best trading has been on the Asia Open. I wouldn't say Asia Open, about an hour and a half into the Asia trade, whatever it turns out being here, what's it, like 9 o'clock to 11 o'clock p.m. Eastern in New York, is typically when I'm really the most active. Other than that, best session is going to be on the Euro Open with Asia. That tends to be a really nice session as well. The crosses, Hamid, is what I want to stress to you. Europe close into US trade, Asia Open into European trade. Hamid says, thanks for your explanation. Smiley face. I appreciate that, Hamid. I hope that helps. And man, you're in the right place. If there's any questions, guys, at any point about something specific that you're having problems with, do feel free to throw us a message here in the text box. Eileen says, missed it here. Work in the way of work, had a client, but there it goes. Which one are you talking about there, Eileen? The Kiwi, I assume. Murdad saying, what if the long-term trend is opposite the short-term time or the short frame trend? What trade do you take? Great question, Murdad. Awesome question. That's the biggest advantage of our strategy, is that we can take short-term positions against the long-term trend. Meaning, here's a couple of things as an example. Oh, Arlene, you're talking about the Aussie Kiwi? Yeah, I didn't catch this either. I played it through Way of Aussie, and we'll look at that in a moment. But to answer your question, Merdad, is about playing counter-trend trades. We do that a lot. What's the best example here I can bring you? Well, I guess the Aussie from last night. I might as well just go over that. This was the primary example of trading a counter-trend trade. If you look at the Aussie dollar, guys, I don't care what anyone's saying about the fundamentals. I don't care what anyone's saying about what their opinion is. This thing is not, you know, let me take a step back. So we're in the confines of this broader downtrend. True, off the 2013 highs. No one's going to argue that. That's in stone, right? But the near-term trend has been constructive since the September low. And it's funny because everyone keeps saying, oh, the RBA is going to have to cut rates again. Australia is doing horrible. We got weaker numbers today on the employment picture, obviously. There's been a market change in the behavior of price. What is that? Well, we've broken 60 for the first time in momentum since March. We've broken a major key resistance level, or major key pivot in price, which was 72. And objectively, we've broken back into this. The sharpest part of a downside trend move is typically the break of a descending formation. I know that might be a mouthful there, but the sharpest part of a drop-off will typically be when the market breaks a downtrend like this. So if you're in a descending channel and you break support, that's typically when the market completely disintegrates. Here you didn't see that. Quick recovery, we popped right back in. Another attempt at a try to break below, failed, we pop right back in. So near term, I'm looking higher. So Merdad, that's one magnitude of trend. You jump in closer, even the near term picture off the last couple of weeks has been constructive. So why did I take a short here? This is your question, Merdad, right? What if the near term time frame is against the longer term? That's our flexibility. That's our flexibility. You know why, Merdad? Because I'm not committing to a longer term trend. I'm committing to what the price action is saying now. And right now, as we came into that high, you had a beautiful trigger break in momentum. You had a beautiful spike high on the Aussie employment print, which completely failed right ahead of that confluence. So on the next run up, I was looking for short entry right off the bat. I actually didn't take this, guys. This was in European trade. I took this small move, and the limit was at 73.10. Here's what, let me just, I guess I could just show you the 5-minute for Aussie. We'll see what trigger actually put that trade in play. So it was right here. So this is a 5-minute. The trigger was actually on a 1-minute. I'll show you that in a moment. But you can see price action making a higher high. The oscillator. Momentum making a lower high. Again, subsequent to this, this was the employment read for Australia. Subsequent to that, we made another high. The oscillator making a lower high. So that's a third divergence point into a trigger break. That put me short. Real tight stop on this one. 23 pips is a quarter of the daily ATR. Support was down at 73.10. And that's where we took profit. This was a limit that took me out an overnight. So while the topside trend is in play, this is the flexibility that the strategy grants us, is that we can take near-term scalps against our long-term focus. So where did you put the stop? Says Eileen on this Aussie dollar position. Honestly, it was literally just a couple of pips above the high. I think it started off with a 13 pip stop. On a move like this, it's a pure power play, guys. It's a pure power play because you're getting divergence. You'll know if you're wrong right off the bat. If this thing breaks the highs and breaks momentum 70, so now you'll have no divergence and you made a new high, that completely invalidates what I'm looking to do, right? So on a trade like this, yeah, I'll jump into a scalp sometimes with a 10 pip stop, guys. I mean, I don't want to encourage you guys to start trying to call peaks, but here's what it looks like. Let me put this in focus. Here's what it looks like on the 5-minute. Or excuse me, on the 1-minute. So Eileen, you see that? This is a 1-minute chart. Price action making a higher high, right? Momentum failing to make new highs. So all you're looking for when you're looking for divergence is that the oscillator is not illustrating or not reflecting an extreme in price. So that means price makes a new high or a new low and the oscillator does not. It's exactly what we got into a trigger break. Stop or trigger a short there. Literally a stop was like 5 pips above that high, 10 pips above that high. You're looking for 23 pips. Hamid, I hope that helps to go back to your question on triggers and how to get into the position. Let me know if that offers some further clarity. Eileen says, yikes, you're good. Sometimes it's better to be lucky than good, Eileen. Again, guys, this will come with time. The more triggers you look at, the more attuned you are to intraday price action. The better the better you'll execute. When you take counter trend trades, are you all in, all out basis? Absolutely, Mario. Great question. Absolutely. So what Mario is saying is, when Mario says all in, all out, that means when you take the scalp, as soon as you achieve that first target, you're taking the entire trade off the table. Whereas typically, when we're trading with the trend, and you guys have seen me do this here before, when we're in the trend, I say, okay, I took a half of the trade off here, a quarter. Stop is at break even. I'm looking for the next target. When you're trading with the trend, that's the way to do it. You know, if you look over studies, guys, over retail trading sentiment and retail trading behavior, it's been reflected time and time and time again that the biggest problem with retail traders is that they're very slow to cut losses, but very quick to pull profits. Okay, and we don't want to do that. When the market is, when we're in a great entry, we're in the direction of the primary trend. Even if we're looking to scalp, as you come into those scalp targets, shave some off, bring your risk up. Shave some more off, bring your risk up. But when you're in a counter trend trade, I don't know how deep the stretch is going to be. The stretch could have gone through 73.10 and tanked into 71.80. Would have been great, but it also might have stopped right at 73.10, which was what our target was. It's counter trend. I'm going to be more nimble, all in, all out. Absolutely, Mario. Absolutely. Mario says, can you just remind us again, do you count the quarter ATR from the stop loss or from the entry level? It's from neither, guys. A quarter of daily ATR is from the high or the low of the session. Very important that we keep that in mind. Great question, Mario. Great question. So if there's a pair that's giving you a 50 pip ATR, I'm not going to just jump into a trade looking for 50 pips. That 50 pips needs to be against the high or the low of the session, the high or the low of the day. Make sense, guys? Because the market, if there's a 50 pip quarterly ATR, if we move all the way down to here and I get in a trade, right, on a break of support or something, that's just arbitrary that I'm looking for another 50 pips. Mary, does that make sense? He says, I honestly didn't know that. Good question. Well, I'm glad you brought it up. I'm glad you brought it up. Just think about it logically, right? If the market's giving you 100 pips on a daily basis and it's already moved 100, and I look to take a position, doesn't mean I just automatically target, 25 pips in addition. We've already moved the 100 pip daily ATR. So that's why it's always best to plan your scalps and take them against the extremes of the day, the extremes of the session, and whatnot. That will tend to be the best way to play it. Mario says, cool, I got you. All right, good stuff, Mario. Her dad says, what do you think about taking your profits when the candle changes instead of looking at ATR? Dad, I'm not really sure exactly what you mean by candle change, and the problem I would have with a subjective way of looking at things like that is what time frame would you be looking at? Because I'm sure as hell not going to take a trade off the table because a 1 minute or a 5 minute candle is doing something. And with the same respect, if you wait for a 30-minute candle to close, well, you're likely to have that trade go away against you or away in your benefit before it even closes. We can't make any assertions about anything, guys, in technical analysis until the candle closes, especially if you're looking at an oscillator. This oscillator doesn't get pegged until the candle closes. So a 30-minute, my dad's saying a 30-minute here, might be a very delayed trigger, both to get in and out of the trade. Does that make sense? Candle formations, for me, hold much more significance on the daily chart. So if we're looking at a daily chart and you get a doji at a high, if you're looking at a daily chart and you get an outside reversal at the highs, dollar index, with this rebound yesterday making a huge outside day reversal, right? These are things I'll notice. Early in the month, as we tried to press through that 12,071 region, which was the monthly open, you got another outside day reversal right here on the 2nd of the month at the highs. These kinds of things right here, outside day reversal on the 7th at the highs. These will tend to be things I'll pay more attention to. But on the near term, 30-minute, 5-minute, you'll be chasing your tail. in my humble opinion. I mean, if it works for you, it works. But over the years, I just haven't found it to be a very valuable part of my personal strategy. Merdad, hope that helps. Hope that offers some clarity on that front. Mark Haverman says, great to see you in the room here. First of all, Mark, he says, hi, Mike. Did you show Euro Yen already? If so, no worries. I'll watch the archive. I came in late. No worries. We actually haven't. Actually, I haven't gone through the quick reference for the Aussie, and then we'll look at Euro Yen. So I showed you the scalp on the Aussie, but just to put things in reference, here's what the daily chart looks like. You know, the resistance region that I was loving was the 73.50 region. If you look at that, you're basically looking at the median line off the lows and a confluence dead on with the 100-day moving average. Also have the high day close for the month right there. Three-way confluence, I'll take that 9 times out of 10. Here's what it looks like on the 30-minute. So if you guys remember yesterday in the webinar, as this thing was coming into support and rebounding off of this resistance, right, this is where we opened yesterday's webinar. We said, hey, look, if we break back above 72.60, look for a rally back into the opening range low for the week. And then this confluence region here. And we went over these median lines yesterday. I know it looks like a mess. Somehow there is actually there's a method to the madness, let's just say that, on this pair. I typically don't like to show you guys stuff that's super complicated like this, but it's not really all that complicated. You have a major a major median line confluence all throughout this region. This is where the short was initiated yesterday. This was another beautiful entry. Outside reversal candle at the highs, at resistance. This came about 4:30 in the morning here in the US. Was your best opportunity to get back on the short side. At this point, you're checking support. Okay, the invalidation level for the upside slope in the Aussie is this line right here, sliding parallel that caught the lows earlier this week. So if we get back below this, I'd still favor selling rallies back towards the lower median line parallel, and that takes you into the 50% retracement right around 71.60, 71.58. All right, keep in mind, we're playing the recovery here for the Aussie, i.e. for the dollar. We're just playing the pullback. You know, the operative trade, like I said on the daily chart, is still pretty, you know, we might get a mean pullback here towards 71.80, but still, you know, even a pullback into this region would leave us rather constructive on this trade. Too early to tell as well, but just a quick drill with you guys. I'd start to look at some median lines to give us guidance on the downside. Pitchfork there, highlights, next downside target around 72.33. And again, based on time, whether it's late this week, tomorrow, or early next week, that 71.80 level confluences with that median line right there. So looking to see if this thing holds this formation. If we get a downside break, by the way, as a disclaimer, I'm flat here on Aussie, no positions open, but if we break below this, I'd be looking to sell rallies into that lower median line parallel. If this holds into US Open and you get a pop higher, you know, you're still within this formation for the last couple of weeks. So I personally think you probably make a new low here before it moves higher. So I'm on the lookout for short triggers while below 73.10, which was the weekly opening range low. And that would coincide pretty well with a little rebound in price here for the dollar index. Again, came into a basic trendline support off the lows from May today. Confluence of the 764 retracement off the August low and median line parallel off the highs. So let me clean this pivot up. You don't need that anymore. There you go. Merdad says, thanks, more than welcome. And that is Aussie dollar and dollar index. Any questions on those? Okay, let's jump into euro yen. Mark says, FYI, I went long at 34.95 with stops under 34.81, old confluence 38.2 and 50% in euro yen. Let's take a look. Here's the daily looks like. Yeah, I think we talked about this yesterday, right? Let's see what's going on here. Give me one moment, Mark. Let me just do some on-the-fly analysis here for you. Let me ask you this, Mark. What's your target on the top side slope here? Because if I'm looking at this objectively on the daily chart, you're making an outside day reversal right off the 100-day moving average. I see support a little bit lower from where you are right now, but what's your target on the upslope? $136.20, Mark says. Okay. So first things first, a broader look at the 30-minute. We've obviously been following euro yen for months and months and months and months. It kind of fell out of focus as the euro went into that chop fest over the last couple of weeks. But this rally charging a move right back into that median line. This dates back to the lows we made earlier in the year, specifically in January. You can see a really nice pivot along that slope. We came right into it, pressed lower, completed an exact 1618 extent. Oh, came just short of a 1618 extension off the low. And here's the pullback. This retracement's correct. Yeah, I mean, Mark, I still have the risk for a drop lower here towards 134.60, 134.65. The basic trend line resistance. This is actually a sliding parallel of the same operative slope we were working with that caught the lows back in September. That sliding parallel coming in confluence with a 618 off the lows, and that swing low from what is that? I guess late August, early September, and that gives you 34.65, 34.60. Mark says, okay, I see that. That's why I love your charts. I took a screenshot. Cheers, Mark. I love the idea. I like the idea. And specifically with a little yen bounce higher, so that's yen weakness, you might actually get a nice upward bounce, but I'd be looking for that bounce to happen a little bit lower from where we are right now. One other thing, Mark, I never want to underestimate this, brother. When you have momentum in oversold condition, this is when the market has the most downside pressure. Forget what you read in the books, guys, that when something's oversold is when you want to buy it. This condition can stay like this for hours, days, weeks, months, years. There's nothing that says something needs to come back from oversold or overbought territory. It's the act of recovering from that that would be the tell that you're getting a turn in momentum. I'll bring your attention right here. You know, this thing broke into overbought territory way early in the session yesterday. If you would have started trying to short this yesterday, you would have gotten smoked on a 150 pip rally into 137. Okay, all this time for a good, full session in Europe, this thing was in overbought condition. So just keep that in mind. I'm very cautious when I try to fade a move if it takes momentum into overbought or oversold. Does that make sense, Mark? He says, I agree. On the 30-minute, it seems to be getting a 40 hold on the 4-hour chart, RSI, I mean. So it depends what you're looking to do. If it's a near-term trade, 4-hour RSI is not really going to do you much justice, Mark, right? Because it can dip another 50 pips and recover before that 4-hour candle closes, and it'll look like it never even broke. So we got to keep in reference when we're looking at the momentum what time frames we're looking at. Just as a disclaimer, guys, all momentum signatures are backwards looking, right? There's nothing magical about CCI or RSI or stochastics. These are all backwards looking oscillators. It tells you what happened, not what's going to happen. So with that in mind, we want to make sure that we're getting a signature that's really reflecting more so what near-term price action is doing, which is why when we look for the triggers, we'll jump into a 5-minute, we'll jump into a 1-minute, right? Those are going to give us a little bit more hardcore what's happening in the now. But anyway, I went on a little tangent there. Mark, hope that helps. As far as Euro Yen, I think you could get a bounce, but I'd be looking a little bit lower first. Okay. That figures everything on my list of things. Oh, crude. How can I forget? Good old crude. Feel free, Mark says, thanks as always. Hey, you're more than welcome, man. Always good to see you in the room. As always, guys, feel free if there are any last-minute questions or trade setups you want to review. I would be remiss if I left the session without going over some of these major commodities here. So here's what crude looks like. Everyone's going to be watching this today. You're pressing a near-term major critical support, i.e., let me just zoom this out for you. So basic trendline resistance, as basic as it gets off the June high from last year, tagged again in September, tagged again earlier this year in June. We broke that with that rally earlier this month. We're just simply checking former resistance as support. That's it. Add to that basic trendline support off the yearly low. Cool. Add to that a 38.2 retracement off the low. Okay, so there's a reason to be cautious on the short exposure here for crude. You've had today would be the fourth consecutive or the fifth consecutive day of declines off the highs, and momentum is testing 50. Remember, this doesn't mean anything until we get the daily close candle. So yesterday we were just above 50. Now it looks like it's pressing, but we can't make that assertion until the candle closes. Long story short, the short bias is at risk above 45.80, 45.70, where we are right now. And I highlighted this chart yesterday on the radar charts as well. Here's what it looked like. So just be cautious. If this gives out, you really have nothing on tap till 43.50 as support. All right. I'd be cautious, though. I'm really not looking for any short exposure at this point. Actually, on the intraday, I'd be starting to look for a long trigger as we head into the U.S. Open. If it gives out, like I said, I'm just not going to touch it. Just not going to touch it. We'd need to get back above that median line in blue to get constructive on the pair again, or on crude rather. Make sense? Cameron says, gold, please. Coming right up, sir. Here's what gold looks like. We've been following this one very closely as well. Here's the weekly. Just want to highlight a couple of levels that we talked about in yesterday's webinar. That confluence region with the 200-day moving average and the median line. Man, we blew right through that today. That was 1181. We blew right through it. I think the high was 1194. 1190 was the high. And I'm not really interested in trying to press the long side, even from a scalp basis now. I want to see it close above the median line. Then you have a clear-cut topside target at that swing high, the upper median line parallel that takes you to 1232. And it's crazy because we were talking about 1180 and people thought we were nuts back when this thing was trading at 1080. Here we are. Okay, we pivoted above a major key area of support, even on a pullback scenario, as long as you stay above 1155. I really wouldn't be looking to press a short in gold. Here's what it looks like. So this is the weekly chart. We'll want to see the weekly close at or above that median line to maintain a topside bias heading into next week. On the daily, here's what gold looks like. Okay, so again, remember you were looking at that 52-week moving average on the weekly chart. Guess what? The 200-day moving average also comes in this region, only in here, it's serving as support. So we broke through it yesterday, closed well above it. On the pullback today, that's where we found support on both pullbacks. Momentum above 60 and its highest read since January. Key topside resistance beyond here immediately takes you into 1198, 1194. Actually, I take that back. No, I don't take it back. Sorry about that. That's actually a good region of resistance right there. So you're looking at a 1618 extension from the advance off the September lows, a 764 retracement from the decline off the May highs, and basic former trendline support now serving as resistance. A topside break, like I said, 1223, 1225 would be your first target, but then you'd be looking at the upper median line parallel. Bullish invalidation, 1150, plain and simple. 1155, 1154, plain and simple right there. Make sense? Cameron, hope that helps. On gold, momentum signature looks stellar. Man, it really does. As far as the broader term, like I said, you're on the 5th day of advances. You could get a pullback off 1198, 1194. Just look to stay constructive above 1155. My dad says, could you please take a quick look at the loonie? Sure. Yeah. We forgot about the dollar CAD. We're running over on time, but let me just take a quick look at the dollar CAD for you guys. Here's what it looks like. Listen, at the end of the day, I know the swing trades got pushed out of that one, but you were still really struggling with the same support region. I mean, we dipped below the trigger, but we're still struggling at the same support region, and that's right here. You have the 100-day moving average. You have the lower median line parallel for the operative formation, at least that we've been working with as the operative one. And it's been a little bit more of a slow decay. Like I said, I mean, I don't know. I'd be looking to sell a rally towards 3140, guys. The same thing we said on Monday's webinar is still basically the focus I'm looking for. If you guys recall, we actually had some beautiful scalps on this on the Monday open. But at this point, here's what the 30-day looks, or the 30-minute looks like. The weekly trade session has been kind of messy. Okay, so we were on the long side on this breakdown here, another beautiful long trade that we took out at the 618. Now that we've broken the weekly low, but we're kind of struggling there as support. Personally, again, I don't want to keep telling you guys to press a counter trend trade, but I am still looking higher. You know, if the breakdown would have taken us below 29 and below that median line, I would have said, you know what, forget it. The primary trend, just keep pressing lower in the near term. But, you know, you're coming into support. You got some, I wouldn't call it straight divergence, but you got a trigger break to the upside. You saw a rally quickly fail again at the initial opening range high for the week. So I'm not really a fan of scalping intraday the CAD at this point. If I did, though, feel compelled that there were some nice triggers, this is basically the levels I'd be looking at. It's not bad, actually. So I'd highlight a couple of ranges. This would be the first range I'd highlight of a major critical break, be 29.75 and 29.70. Last week's swing low, 50% of this week's range. More importantly, on the topside breach beyond that, you'd essentially be looking for the median line, which coincides basically with that 786, 130.35. Again, it's just the risk of recovery. It's not really a broader shift in the pullback that we saw off the September highs. You're likely to make a new low here still. It's just that the risk for a snap higher before you make that low is there. Momentum is grounded, sitting at 40 support. You know, we haven't seen a dip sub 40 since May, essentially. But those are the levels I'd be looking at as far as the loonie is concerned, my dad. Let me know if that helps or if you have any specific questions. It says thank you with a smiley face. More than welcome. More than welcome. Cameron, one last thing for you. Sterling Oz, I'll take a quick glance on that. Look, I think the daily chart's more telling than anything. If you take a look at Sterling Oz, the support that we rebounded off of on Monday was stellar. Again, another beautiful confluence. You had a basic 38.2 retracement from the yearly range, lower median, or excuse me, the lows rather from August. Nice confluence region there. You saw the rebound. Bearish sub 213.98. Let's just call it 214, 215.40. Bearish below this region. We went over this yesterday. I'd look for a rally there to sell. Other than that, you're right slap in the middle of the monthly range. No trade here for me. Nothing really here that's screaming at me. I'd be looking for that push higher to get on the short side. From here, actually, this looks like a 1, 2, 3, 4, 5 wave up. So it would suggest that you have one more high to make before it turns over. On this type of correction, move higher, then move back to the downside. The broader slope, though, and this is the one that we covered yesterday. That's what I'm looking at. So feel free to take a snapshot of that if you need it, Cameron. He says, thanks, man. Hey, my pleasure. Christopher Hudson says, thank you, Mike. Very helpful as usual. So, guys, I want to thank everyone who attended today. Best of luck trading for the rest of the week. We'll be back on Monday morning for the public webinar on Daily FX, and then Tuesday, Wednesday, and Thursday of next week, all at 8:30 Eastern. I'll give you an update tonight if there are any other setups that kind of pop out at me. Quick reference, there might not be a scalp update per se on Sunday night. I will be traveling. I'll try to get one out for you guys, but if not, we'll pick things up on Monday. Best of luck trading for the rest of the week, guys, and have a great weekend. See you then. Cheers.